Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, real estate, insurance, loans, and everything else to do with your money. Well, we'd love to keep the show interactive, so please feel free to write with your questions and queries on the link below. Well, I'm Samina Nalwala, and let's take a look at the top headlines this Monday evening. LIC, which is Life Insurance Company, gained 1.5% post earnings. Although the reporting was 3.8% drop in net profit compared to last year, most brokerages still remain constructive, with Citi setting a target price of 1,385 rupees apiece, which suggests a potential upside of 50% from its current market price. However, there are some analysts that still believe that this counter could face some pressure and remain cautious as new surrender value rules that come into effect on October 1st, 2024 could cap the gains on its earnings. These rules allow policies bought after this date to receive a surrender value starting from its first year. While this may benefit policyholders, it could impact the insurer's margins and lead to higher premiums. Another company that reported earnings the weekend was Tata Motors. While the earnings were largely in line, JLR's guidance and reduction in free cash flow meant that the stock did see brokerages react. Well, most brokerages such as CLSA remain and outperform on the counter, but many others believe that they should review their price downward on the stock, particularly on back of a reduction in free cash flow for JLR. Well, CLSA now has a target price of 968 rupees for Tata Motors, citing a stock correction as a reason for the upgrade. The stock, remember, is down over 30% from its recent peak. Nomura has kept its buy rating on Tata Motors but lowered its price target to 900 from 1303. Jefferies, in the meantime, maintains its buy rating but lowered its price target to 1,000 rupees from 1330. Of the 36 analysts tracking the counter, 22 still maintain a buy, 9 have a hold, and 5 recommend a sell on Tata Motors. It's gold that's back in the news. This time around, gold continues to see selling pressure, down nearly 1% in Indian markets on back of a global dollar strength. Investors await key US economic data and comments from the Federal Reserve to identify and determine the US interest rate trajectory going ahead. Earlier today, MCX gold for December 5th expiry was down 0.72%, trading at 76,714 per 10 grams. Globally, gold prices have been seeing some selling pressure and are down for the second consecutive day. Well, from gold to onions, it seems, and onions is what's making consumers cry. Rising onion prices are causing concern for India. In several areas, including major cities like Mumbai and Delhi, onion prices have reached a 5-year high, climbing to 70 to 80 rupees a kg, up from 40 to 60 rupees a kg. In Delhi, the wholesale prices have surged significantly, and vendors are struggling to keep up with the increase. According to sellers, even though the rise in prices is impacting sales, people continue to buy onions because it's an essential part of the Indian meal. Well, those are the top headlines that we are tracking this evening. But now, time to get into a very interesting conversation. Can you retire at 40? Is this a dream or can this be a reality? Joining me today to take this discussion forward is Sunil Jhaveri, founder and chairman at MSJ MisterBond. Hi, Sunil. Thank you for joining us this evening on the channel. Sunil, I'm going to start with a very interesting conversation appealing to a very large audience on social media. Is retiring luck by chance at the age of 40?
Thank you, Samina, for inviting me again. It's a very interesting topic and very dear to my heart also, because I speak to a lot of youngsters and try and guide them on the right path on their financial journey. It can be luck by chance if you have not decided on this as a goal from starting of your career. Then you'll have to depend on either winning some lotteries or having some windfall gains, or depending on your performance bonuses, or even on inheritances. So that can be luck by chance if you've not planned for it from day one of starting of your careers. But if you know and you're very sure that, yeah, I want to retire at the age of 40 before you start your career also, then you can take a lot of decisions which will give you a chance of retiring at the age of 40, and it need not be luck by chance.
I'm glad you said that, right? Before you start your career or when you're just about setting your career. Because if you're 39 and looking to retire at 40, then I think it would even take more than luck by chance. But okay,
Absolutely.
I think that brings us to a great starting point, right? Now, assuming this is a dream of somebody who's right out of college, starting his first job, very clear that he or she wants to hang his or her boots at the age of 40. Now, all this one becomes about input and then output. Input is one thing that you may or may not be able to control, and that will determine what the output is. But assuming your goal is retire at 40 with a significant corpus, what are the key things to keep in mind when you're setting a financial goal that some believe may be quite ambitious actually?
Yeah, it can be ambitious, but as I said, there will be a lot of discipline required. There will be a lot of sacrifices, because you'll have to do a lot of non-spending on your instant gratifications. Youngsters, as you know, would like to have a new iPhone every 6 months, or spend on luxuries, or cars, etc., etc. So instant gratification is what you'll need to sacrifice on if you wish to retire at the age of 40. And begin with, if you already decided in this in colleges also, so you may get some pocket money, you want to save that and invest that. You may have worked under with various organizations as interns, and you may get some stipends, and you want to save that, invest that. So these are the steps which will help you, and move away from creating a debt trap for yourselves by get not getting into the syndrome of buy now and pay later, because that is a sure way of not making not retiring at the age of 40. So first and foremost, save and invest from whatever sources which you think you can generate cash flow. uh, Avoid instant gratification and postpone it as much as you can, and avoid debt traps from buy now and pay later kind of a situation. That will help you in actually achieving your goal, but it will require a lot of discipline, sacrifices, as you can imagine.
You're right. So spend less, save more, uh, avoid debt traps, and more importantly, avoid the buy now, pay later, which truly has become a big trap of the current generation. But Sunil, let's help our viewers who are even thinking about this, right? It's very easy to qualitatively say, I want to retire at the age of 40. But I think a good question for them to ask and maybe ask a financial advisor is, how do you quantify, or is it important to quantify the corpus of money that's required at the age of 40? Because only then would you have a objective goal in that sense, right?
Well, naturally, you'll have to have certain, some kind of a guideline or a amount which you want to save and invest, so that you arrive at certain corpus at the age of 40. Naturally, you'll have to take into account the impact of inflation. So if you are at the age of 25, create, get into the impact of inflation and then arrive at that figure. So if you are talking of, say, 1 crore at the age of 40, just for an example, it may not be sufficient if you're not taken into account the impact of inflation. So the impact of inflation is going to add further. So you had to say save and invest for arriving a corpus of 2 crores, and if you only done it for 1 crore without taking into account the impact of inflation, naturally there will be a huge shortfall there also.
Right. Sunil, okay, so once we've identified and quantified the amount of money one requires at 14, I guess a lot, like you said, inflation being one of them, tracking your expenses, extrapolating what that would be when you're 40, are things that you have to, I guess, sit down with an advisor and sort of work on. But how important is it to start early? In fact, how long do you think one needs to do this for in order to set out a goal like retire early or retire crorepati at the age of 40? Starting at 30, is that an option? Is there a possibility? Is there a probability? And I do know that, when we set out goals, there is possibility and there's probability. Possible to sab kuch hota hai, but we have to work with probability, right? So would you agree that the earlier you start, the better it is? The later you start, the closer to impossible this gets?
Absolutely. So, power of compounding is not front loaded, power of compounding is back loaded. So, sooner you start and let your money grow and compound, then it will be easier for you to achieve your goals. But if you say that I'm going to postpone it by another 5 years, 10 years, etc., there is no way on earth, unless and until, as we said, luck by chance, inheritance, performance bonuses, windfall gains, etc., and then that money gets saved and invested, then only you'll be able to manage it, not otherwise.
Right. Also, okay, let's now talk about two parts to this. So, if you do inherit wealth or inherit a significant corpus at a young age, do you then invest that corpus immediately in a lump sum way? Second question, if you do not have an inheritance at an early age and you still aspire to retire at the age of 40, then how much of your earnings would you advise being invested on a monthly basis?
So once you have the inheritance, let's talk of the first case
Yeah,
first.
because that's clearly is the easier and more realistic way to do this.
Yes, so as soon as you get your inheritance, you save that money, you invest that money. Naturally, the power of compounding will kick in at 5 years, 10 years down the line, and you will definitely be able to retire depending on the corpus which you have inherited and how you have saved and how you have invested. But if you've not saved and invested, and everything is dependent on the individual circumstances. So there can be a person A and person B. Person A might be earning more money than person B, but it is the mindset and how you manage that money is what is going to determine whether you will be able to or you will not be able to achieve those goals. So if person A says, I have extra money, I'm going to spend that money, I'm going to splurge that money, I will start my investment journey and savings habits maybe 5 years, 10 years down the line, then that person may not be able to retire even at the age of 60. But a person who has a mindset and who was determined right from day one, even before he starts his career, let's assume in his college days only, those who are youngsters who are watching this, show, they should understand that if you have decided that I want to retire at the age of 40, start from as of yesterday and not as of tomorrow. It's as simple as that.
Hmm. Also, one more thing, Sunil. While you can, say I'm going to retire at the age of 40, but between 21 and 40 also, there are so many life goals that one wants to accomplish, right? You may want to get married. You may have children. You may want to buy a home. You may not want to buy an iPhone or shouldn't buy an iPhone, but you might need to buy a car. You might want to have more short-term goals like going on holiday. Do you think if you want to retire a crorepati or I think उससे भी बड़ा अब जो है वो जो Hi, sorry, Sunil, did you hear me?
No, I didn't. I did not get the last part of the question.
Sorry, Sunil, did you hear me?
No. So if you can repeat the last part of the question.
Yes, I said it's one thing having a goal of saying I want to retire as a crorepati at the age of 40. Point taken. My second
Right.
question is between the age of 21 and 40, there are many other life goals, right? You may get married,
Absolutely.
you may have children, you'll have school fees, you may not buy an iPhone, but you still may want to buy a car or go on an international holiday. Retiring at 40, will that come at the cost of compromising on these other life goals? I mean, single people may have a better chance of retirement.
No, 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 absolutely. You will have to compromise on a lot of your goals. It can be buying a car. You don't need to buy a car. There are Ubers and Olas of the world. So many youngsters don't want to own assets, which is good for their own, in their own journey, financial journey. Many youngsters are staying with their parents, so they are not paying rent also. So people must realize that the youngsters at the early stages in their life, they have more disposable income than what they actually think. They think that they have no money left because they are splurging or spending more money than what they are earning. That's the reason why they are not able to save and invest. But youngsters, if they are staying with their parents, they're not paying any rent. They don't want to own a car, so they're not going to pay any EMIs. They may want to compromise from not going abroad and taking holidays in India. So these are the compromises which they will have to take if they are going to be strict and that one life goal that I want to retire at the age of 40. So if that be the case, then naturally there will be many compromises, many gratifications which they'll have to postpone. instant gratification, as we said, and they'll have to start thinking of where they need to spend less or not spend at all and save that money.
That, on a lighter note, Sunil, our headline this evening was onions at a 5-year high. Pretty contradictory when you're trying to retire early in such an inflationary economy. But okay,
Yeah.
once we've got the inputs control, I noticed you didn't comment whether they should get married or retire single because the
No, no.
chances of retiring richer is much higher then. But let's talk about actionables. Managing risk, right? Now, you have such an ambitious goal like retire at the age of 40, retire rich. But while you may get carried away at the age of 21, you may take on unwanted risk to generate significant or non-linear returns in that ways, right? What is your advice? How important is it to balance aggressive risk management to minimize risk to maximize returns in a relatively shorter time period?
See, first and foremost, you are talking about retiring at the age of 40, so you only have a limited span of 15 to 20 years to save and invest. So, first and foremost, you must have that mindset of downside protection, and the returns can be a byproduct of the strategies which you adopt. So, you don't want to, first of all, go aggressive on risks and start taking, shortcuts to make that money. You don't want to be like a driver on a toll naka where you're changing lanes in the hope that something else will, the other lane will start moving faster. In the bargain, you may have left behind a lane which was moving slow, but it has started moving faster. So to just to give you an analogy, in the investment parlance, you start investing in, say, equity. All of a sudden the equities have started going negative, so you say, no, I will stop my equity investments and I'll start something else. So you get into debt or gold or wherever, and in the bargain that you realize that all of a sudden the equity has started doing well. So you'll have to have discipline. You have to have proper guidance in terms of which asset class you need to invest in, for what time zones, and at what levels of market valuations you need to invest. So people talk about long term is 3 to 5 years, but we are talking of 15 to 20 years. But if you've not selected the right asset class for the and the right investment vehicle for your corpus, creating those corpuses for retirement, you may not be able to achieve any of them.
Mm. So, would you say, while I take your point, debt is also important because it cushions a portfolio, equity portfolio, which is usually volatile. But we also know that if you have to generate non-linear returns or significant wealth needs to be created, the vehicle to choose has to be equities. So, in that situation, do you think equity heavy or an equity bias portfolio is what should be and what would be recommended?
No, it's a myth and a misnomer that only equities can deliver returns. Unfortunately, people have very short memories. 1992 to 2002, during Harshad Mehta, post Harshad Mehta scam, 10 long years, equities delivered no returns. If you had invested in January 2008, and that's almost 16 to 17 years back, you would expect that equities should have delivered 15 to 20% returns because we are at an all-time high. It has only delivered 8.5% return. The reason being that you've invested at the worst valuation possible in Jan 2008. So you need to understand that there is a rotation of asset classes, and that's the reason why multi-asset themes are becoming popular. So sometimes equities will do well, sometimes debt will. Debt is just a temporary parking of vehicles. Please understand that till you switch from debt into equity at the right valuation, and sometimes gold and silver will do well the way they are doing currently. So there is a rotation of asset classes. You have to be in the right proportion in each asset class and at the right valuation, so that each asset class delivers returns to you.
So, assuming we are starting today and you're giving advice to a 23, 24-year-old who's come and told you, I want to retire, sir, at the age of 40. In that case, given where equity valuations are, given that the road behind actually has been quite glorious, how much percent of his portfolio would you recommend being invested into equities?
So currently we are neutral in the sense that we can be at least 50% in equity, if not more. Then there can be an allocation of 10 to 20% in precious metals, which includes gold and silver. That will cushion, because the global macro factors are not conducive for a global growth. And if the global growth is going to be suffering, naturally Indian growth also will suffer, and it will have some impact on the equity market valuations also. So at the current juncture, because markets have come up from the recent highs, 40 to 50% allocation to equity, another 10 to 20% in precious metals, and balance in debt kind of a product or arbitrage kind of products to be parked to be switched into equity at right valuations.
So we're also going into a time, like you said, where the rate cycle will be easing. So there is talk and conversation that debt may be able to give you double digit returns. In that situation, if you've got the next 15 years, for the next 2 to 3 years, do you feel debt could have the ability to generate and create alpha? And hence, maybe some part of that arbitrage money or high risk money can be moved to debt. This is for somebody who's starting today and building a portfolio for 15 years.
Yeah, yeah, sure. But we discussed this in the last episode also, Samina, that debt is the most misunderstood
Yeah, I
asset class.
agree. Yeah.
When then
And
it's
now
more
we're
volatile
talking
than
about
risky
it
also.
because the RBI is talking about rate cuts. So at least the Fed has cut rates.
Correct, correct. Absolutely. In spite of that, RBI has not cut rates. So let's assume
Yeah.
that somebody invested few months back in the hope that RBI will cut interest rates immediately post Fed cutting interest rates, and it has not happened, and the interest rates have actually gone up. What will they do? Because they will see volatility, negativity in a debt portfolio in the mutual fund space. You don't want to go there because they will not understand what is modified duration. They will not understand what is yield to maturity. How does it impact that there is a reverse correlation between interest rates going up and the price of the bond. So all these are very complicated issues which people will not be able to understand. Let debt be a temporary parking, earning you 6, 7, 8% kind of returns, not for generating alpha. If alpha happens, well and good for your portfolios. But otherwise, to get into a product which is high duration, long duration products,
Yeah.
and volatility again in the portfolios besides equity, then it'll be double whammy for them.
Right. Also, Sunil, always tough, I know, but what percentage of return should one be aiming for uh, if they want to retire in 15 years?
So it is not up to the investors to decide what returns they should look for. It is the market which will determine what returns the markets will generate depending on the current situation. So as I explained to you, if you are invested in Jan 2008, after 16, 17 years, you would have expected at least 15% returns out of equity. It has delivered 8.5%. There's a gap of almost 7%. So where will the investors go if such a situation arises? So what I try to tell the investors is respect market signals. Markets are giving us signals on a day-to-day basis, and if you respect market signals, markets will deliver returns for you. So you don't just get carried away with buy and hold and sit karo bhul ja. Uh, you may get trapped into at wrong valuations.
So then, are we saying that retiring, and again, I'm using an example because I think it's just easier. If one needs to invest today and retire in 15 years, is it completely market dependent? There's very little in your control.
Absolutely. So same, if you had, let's assume that you were talking of you were 25 years of age in January 2008 and you wanted to retire currently, which is exactly 15, 16 years later.
Yeah.
Would that 8.5% be enough for you to have, generated enough wealth for you to retire? Naturally,
But
you would
Sunil,
have.
but then if, okay, sure, if equity is underperforming, was debt outperforming? Because I think the returns are to be seen at a portfolio level as opposed to at a product level, right?
No, but they've been told that equity will only perform. So that's the reason they would have been equity heavy, right?
No, but if you're
But
building a portfolio today which is 50-50, then
correct.
what percentage of return should I be aiming for? Now, whether it happens or not is what we'll have to
Yeah,
constantly
yeah. So
evaluate.
I agree. So basically, if you are respecting markets and the signals which they are giving and the valuations of the markets, and then depending on that, if you are investing, one should expect it's nominal GDP. Nominal GDP is basically your GDP growth of the country plus the inflation. So if the GDP growth is supposed to be 6 or 7% and inflation is another 6%, so nominal GDP is supposed to be say 12% per annum. That is the market expectations of the returns which you should expect. But because the corporate earnings and markets should deliver 2 to 3% higher than that, so if your nominal GDP is 12% over the next 10, 12, 15 years, you should expect 14 to 15% return if that be the case.
And if you do generate 14 to 15% returns compounded over a 15-year period, what sort of corpus could we look at? A, and B, how significant is the power of compounding? Because you don't want to break the power of compounding, from what I understand, right?
Sure, but corpus will all depend on, you can't generalize it. Corpus will depend whether I'm able to save 10,000 rupees per month, or am I able to save
Correct.
1 lakh rupees per month?
Right. So I think if you to sort of sum this conversation up, while it's a whole lot easier to retire if you've got significant inheritance, I think the other one role people talk about frequently or have been in the last few years is that one unlisted investment that created a significant alpha, right? I mean, you bought into maybe a Swiggy or Zomato and the fortunes change. How much of your portfolio can go into unlisted investment on the hope that over the next 15 years, if you get a good exit, your returns can significantly jump up? Do you think, again, this is luck by chance?
No, no. So unlisted securities and investments can only happen once you created your corpus for your retirement. And after that, whatever is the additional money which you may generate and you may wish to, you know, I don't know to how to use the word gamble around or whatever. So if somebody would have invested in say Paytm, where would he be? Or
Hmm.
somebody had invested in Zomato to start with, then it went off
From
for a long
70 to
period.
40. Yeah.
Yeah, and
Yeah.
then it started doing well. So it's not there are no luck by chance and there are no shortcuts. It has to be a slow and steady process of creating a corpus for yourself, a discipline for yourself, avoiding debt traps, saving as much as you can from your income which you generating, postponing your instant gratification purchases and spending. So all that will come into play only, and then only you will be able to manage to retire, if at all, if you manage this 15-year long period of your, career, and then retire at the age of 40.
So I think it would be fair for us to say possibility, sure, probability is still low. Sunil, with
No,
everything that we have at a hand,
probability is also high if you are sticking to that discipline, perseverance, avoiding debt traps,
working
and
really hard.
working very hard and saving and investing every single penny which you can spare.
And how important or significant is it to actually review that portfolio? Because, like you said, right, you can't do a sip and forget about it. And then say
Sure.
15 years later, look at my portfolio.
Yeah, so
Is
you
it
don't look at
supposed
your
to be
portfolios every
actively managed?
Yeah, yeah. You don't look at your portfolios every 6 months or 1 year, because otherwise you'll get into what we call action bias and take unnecessary calls on your portfolios. Let's assume that you started your SIP and the SIP started delivering negative returns and you're reviewing your portfolio. Actually, a SIP delivering negative return is very good for your portfolio if you're a long-term investor of 10, 15 years, because you're accumulating more and more amount of units. So these are things which you need to avoid by doing unnecessarily too frequent portfolio review every 1.5 2 years or even 3 years, portfolio reviews, and seeing that you're on the right track, your schemes which you had selected are delivering returns or not delivering returns, etc. So that should be good enough. And of course you need to sit with your advisors, uh, unless and until you're such a savvy investor that you understand all the nuances of investments.
So you need an advisor. You need to reevaluate or evaluate your portfolio not too often because there could be decision paralysis, like we say, right? What you
Irrational
also
decisions sometimes.
irrational decision. You just act to act. But most importantly is you need to track your expenses, manage your cash flow. I think be disciplined because
Do
that's very
that more.
important.
Yeah, do that more periodically than the other side.
So track your input more than your output because
Output.
output, like
Absolutely.
Sunil said, is a function of the markets. What you can do as an
No, I
investor is
always tell
manage
the
the risk.
youngsters that you create an Excel sheet of all the expenses which you can think of, movie outing, dinner outing, whatever you can think of,
Yeah.
and start figuring out where can you spend less, one movie outing less, one dinner outing less, and save that money and start saving that, investing that money. So even if you start managing say a 5,000 rupees per month kind of a spend less, that 5,000 can accumulate into almost crore plus kind of a corpus also over a 15-year period.
Hmm. Sunil, I'll take a few questions because we've got some and it's already 5:30. But Charmi Patel writes and she says, I'm 22, started working 5 months ago. How much of a corpus should I have saved or created to be able to retire at 40? Now, this is Googlies. You've got to do some math over here.
Yeah, yeah. I really have no idea what kind of earning she has, and what kind of saving she's already done. But all I can say is that, and I'm assuming that she's staying with her parents, so she has more disposable income than what she would have done if she was staying on her own, paying rent. I'm assuming she's not married, so expenses on your spouse, your kids, etc. So this is the time when you can actually save and invest maximum amount of money. I have told my boys also that 60 to 70% of your income should be saved and invested at that stage. Now
Also,
you
maybe
don't.
what we can help her with, Sunil, is tell her how does she calculate the amount. So if she's assuming, for assumption, she's spending 50,000 rupees every month uh, on
I'm
basic
saying no,
expenses
just work the other way around. Let's assume that I have a lakh of rupees per month as my
to save.
income.
Yeah.
To
Okay.
and and then you assume that what are the bare minimum expenses which I need to do it, because a lot of expenses must be borne by the parents also. So if that be the case, then 60 to 70% of the income is what they can save and invest, is what I'm trying to tell the youngsters.
And if you invest, assuming 70%, which is 70,000 rupees a month,
You can
and you
it's huge sum of money which they can accumulate over 15 years, because 70,000
really
per month plus increments next year onwards,
10% on
bonuses,
that, yeah. And just to
top up.
quantify it, how many years does it take to double your money if it
At
is
15%
going at
double your money. It's a rule of 72. So 72 divided by the rate of return is the
say
time
50,
when
okay,
you will double your money.
so 72 divided by 2, you
Say
said.
10%, let's assume 10% is your rate of return or
Yeah,
12% is your rate of return. The 72 divided by 12 means in 6 years you should double your money. So
okay,
if
so
it
I
is
think Chami, that
15%,
explains it.
if it is 15%, in 5 years you should double your money.
Right. So, Chami, I think we tried to explain that to you. You save 70% of your money, just continue living with your parents. Don't go
Absolutely.
out too much. Stop living, maybe. That's what you want to do. All you need to do is breathe and not eat onions. But
Yeah.
that's, of course, on a lighter note. But yeah, be very clear about the goal you're trying to achieve. The next question is from Vineet. And Vineet says, what if closer to a desired retirement age, I feel I need more money to be able to live more comfortably? Uh, any last minute steps one can take?
Last minute steps is, when you're closer to your retirement, you should start paring down your exposure to equity. So let's assume that you were 100% in equity at the age of, say, let's talk of a regular retirement period, where at the age of 55, you wanted to retire at the age of 60, and you have accumulated corpus for that retirement by age of 55. You should have been debt free by that time. Number one, that's most important. And number two, whatever is the corpus which you have derived, ideally it should be switched into a product like balance advantage fund and reduce your risk, because in 5 years down the line, if your corpuses are supposed to be giving you that retirement corpus, and markets, god forbid, have something like March 2020 happens or March 2009 happens, where will you go? So 5 years prior you should start checking whether you if you've created enough corpus, then you start safeguarding that corpus.
Right. Sunil, one last question from Ashish, and he says, I think this is what you and me talked about, but for early retirement, is it better to invest just in equities to achieve his financial goals? I know what you said, so you just want to do a one-line answer because we've discussed that quite a bit.
Yeah, equities at the right valuations. If you're doing a SIP, continue your SIP. Simple SIP baat hai. 15 years of SIP, and in the right schemes, right products, etc. Naturally, all that goes without saying. And if your SIPs are not performing over 5 years or 10 years after, you need to relook at your SIP portfolios also every 3 years to
And you
figure out
need
whether
to
you
do,
have.
yeah, and you
Yeah.
need a mix of equity and debt, you had said, right? It can't
Uh,
just be
in the
equities.
SIP, automatically when you're doing SIP in equity,
Uh,
it will become equity heavy portfolio.
okay.
But at some point in time, when the market valuations are so expensive and your SIP portfolios are also 100% equity heavy, you may want to take some money off the table at that point in time.
Hmm. Right, Sunil, thank you. It's always good having you and having these very interesting conversations. But you have a great evening, and we'll see you soon again.
Thank you. Thank you so much.
Thank you.